Breaking news.
The 1970s were a turbulent time marked by significant social, political, and economic changes. The decade began with the Vietnam War still raging, casting a long shadow over the nation. Social and political upheaval was commonplace, with protests and marches becoming a regular occurrence. The U.S. economy, once the envy of the world, began to show cracks, as industries struggled and urban decay set in. Inflation was on the rise and unemployment was ticking upward, creating a sense of economic instability. This period of economic uncertainty set the stage for a major financial crisis, the stock market crash of 1973 to 74. This crash wasn't a sudden one-day event like Black Monday in 1929, but rather a prolonged downturn. It was a slow, agonizing decline that stretched over 2 long years, eroding confidence in the financial markets. The Dow Jones Industrial Average, a key indicator of the stock market's health, eventually plummeted by over 45%, devastating investors. This crash had a profound impact on the lives of millions of Americans, leading to widespread economic hardship and uncertainty. The causes of this crash were complex and interconnected, involving multiple factors that created a perfect storm. However, 2 major factors stand out: the OPEC oil crisis, which led to skyrocketing fuel prices, and the Watergate scandal, which eroded public trust in the government. These events, one economic and the other political, combined to create a perfect storm that shook the foundations of the financial world, leaving a lasting impact. In 1973, war erupted in the Middle East, a region already fraught with tension and conflict. The Yom Kippur War pitted Israel against Egypt and Syria, leading to intense and bloody battles. This conflict had far-reaching consequences, particularly for the global oil supply, which was already a critical resource. The Organization of Arab Petroleum Exporting Countries, a group of Arab nations within OPEC, decided to use oil as a weapon to exert political pressure. They announced an oil embargo against the United States and other nations that supported Israel, drastically cutting oil exports. The impact was immediate and severe. Oil prices quadrupled practically overnight, sending shockwaves through the global economy. The United States, heavily reliant on foreign oil, was hit particularly hard, facing unprecedented challenges. Long lines at gas stations became a common sight, with people waiting for hours to fill their tanks. The sudden surge in oil prices sent shockwaves through the American economy, affecting every sector. Inflation, already a concern, began to spiral out of control, leading to widespread economic instability. Businesses faced soaring energy costs, which in turn increased the prices of goods and services. Consumers grappled with rising prices for gasoline, heating oil, and other essential goods, straining household budgets. The oil crisis fueled a wave of economic uncertainty and fear, shaking public confidence. It also exposed the vulnerability of the U.S. economy to external shocks, highlighting the need for energy independence and policy reform. As if the oil crisis wasn't enough, another storm was brewing in Washington, D.C., the Watergate scandal. In June 1972, 5 men were arrested for breaking into the Democratic National Committee headquarters at the Watergate Hotel. It soon emerged that the burglars were connected to President Richard Nixon's re-election campaign. What began as a seemingly minor incident quickly escalated into a major political crisis. As investigations deepened, a web of lies, cover-ups, and abuses of power began to unravel. The scandal consumed the nation's attention, dominating headlines and fueling public outrage. The Watergate scandal had a corrosive effect on public trust. Americans watched in disbelief as the highest office in the land became embroiled in a criminal conspiracy. The scandal shook confidence in the government and its institutions. This erosion of trust extended to the business world, further undermining investor confidence already shaken by the oil crisis. The combined weight of the oil crisis and the Watergate scandal proved too much for the stock market to bear. The Dow Jones Industrial Average, which had already been declining, went into a tailspin. From its peak in January 1973, the Dow began a relentless descent. Investors, already anxious about inflation and political instability, began to panic. They started selling off their stocks, fearing further losses. This selling frenzy only drove prices down further, creating a vicious cycle. The stock market, once a symbol of American prosperity, became a mirror reflecting the nation's economic and political turmoil. By the time the crash bottomed out in December 1974, the Dow had lost over 45% of its value. This decline marked the worst stock market crash since the Great Depression. Millions of investors, both large and small, saw their savings decimated. The crash served as a stark reminder of the inherent risks and volatility of the stock market. Section 5. Stagflation, a toxic cocktail of economic woes. The 1973-74 stock market crash was both a symptom and a contributing factor to a broader economic malaise that gripped the United States in the 1970s, stagflation. This term, a portmanteau of stagnation and inflation, described a period of slow economic growth, high unemployment, and persistent inflation. Stagflation presented a unique challenge for economists and policymakers. Traditionally, inflation and unemployment moved in opposite directions. During economic booms, inflation would rise as unemployment fell. During recessions, inflation would subside as unemployment rose. Stagflation, however, defied this conventional wisdom. The causes of stagflation were complex and multifaceted. The oil crisis played a significant role, driving up prices and disrupting production. However, other factors were also at play, including declining productivity growth, government spending on social programs, and the Federal Reserve's monetary policies. Section 6. The aftermath, picking up the pieces. The 1973-74 stock market crash and the ensuing period of stagflation had a profound impact on the United States. The crash eroded public trust in the stock market, making many Americans wary of investing. The economic downturn led to job losses, business failures, and a decline in living standards for many. The crash also forced economists and policymakers to rethink their assumptions about how the economy worked. The traditional Keynesian economic theories, which had dominated post-war economic thinking, seemed inadequate to address the challenges of stagflation. The Federal Reserve, tasked with maintaining price stability and promoting full employment, faced a difficult dilemma. Raising interest rates to combat inflation risked exacerbating unemployment. Lowering interest rates to stimulate growth risked fueling further inflation. This policy conundrum highlighted the complexities of managing the economy during a period of stagflation. Section 7. Lessons learned, regulatory responses, and market reforms. The 1973-74 stock market crash, like previous crashes, prompted calls for reform. Policymakers and regulators sought to prevent a repeat of the devastating losses and economic instability that had characterized the crash. One area of focus was investor protection. The crash exposed weaknesses in the regulatory framework governing the securities industry. In response, Congress passed legislation strengthening the powers of the Securities and Exchange Commission, or SEC. The SEC was given greater authority to oversee brokerage firms, regulate trading practices, and enforce insider trading laws. Another area of reform was market transparency. The crash highlighted the importance of timely and accurate financial information for investors. To address this, the SEC implemented new rules requiring companies to disclose more information about their financial condition and operations. These reforms aim to create a more level playing field for investors and reduce the potential for market manipulation. Section 8. Echoes of the past, parallels to modern economic challenges. While the 1973-74 stock market crash may seem like a distant memory, its echoes can still be felt today. The lessons learned from that era continue to inform our understanding of economic vulnerabilities and market dynamics. The economic and political forces that converged to create that crisis, oil shocks, inflation, political scandals, and loss of public trust, have resurfaced in various forms in the decades since. These elements have a way of reappearing, reminding us of the cyclical nature of economic challenges. The global financial crisis of 2008, for example, shared some similarities with the 1973-74 crash. Both events shook the foundations of the global financial system and led to widespread economic turmoil. Both were preceded by periods of economic exuberance and excessive risk-taking. Investors and institutions alike were caught up in a wave of optimism that ultimately proved unsustainable. Both were amplified by weaknesses in the financial system. Structural flaws and regulatory gaps allowed risks to accumulate, leading to severe consequences when the bubbles burst. Both led to sharp declines in asset prices, widespread economic hardship, and calls for greater regulation. The aftermath of these crises saw significant changes in financial oversight and policy measures aimed at preventing future collapses. The COVID-19 pandemic, which began in late 2019, also triggered economic shockwaves that rippled through the stock market and the global economy. The sudden halt in economic activity was unprecedented in modern times. The pandemic disrupted supply chains, caused widespread business closures, and led to a surge in unemployment. The economic impact was felt across all sectors, from small businesses to large corporations. While the policy responses to the pandemic differed from those of the 1970s, the underlying economic challenges, inflation, supply chain disruptions, and uncertainty, had a familiar ring. These recurring themes highlight the importance of learning from past crises to better navigate future economic storms. Section 9. Conclusion: the enduring legacy of the 1973-74 crash. The 1973-74 stock market crash stands as a stark reminder of the interconnectedness of the global economy, the fragility of financial markets, and the importance of sound economic policy. The crash exposed vulnerabilities in the financial system, led to reforms that strengthened investor protections, and forced a reassessment of economic orthodoxy. While the crash was a painful experience for many, it also served as a catalyst for change. It underscored the need for vigilance in monitoring economic trends, for adaptability in responding to changing circumstances, and for a commitment to policies that promote sustainable and equitable economic growth. The lessons learned from the 1973-74 crash continue to inform economic policy debates today. As we navigate the complexities of the 21st century global economy, understanding the causes and consequences of past crises can help us better prepare for the challenges and opportunities that lie ahead.